Well, good morning, everybody. Thank you. Oh, okay, got it. Carlos, can you click on that, take God out? Got it? Out. Thank you. Now, I could probably do it.
I can do it in this one.
All right, thanks. Well, good morning, everybody. Thanks for coming today. So the topic of the day is, does a transfer of a present interest in real property occur only when a sale takes place? So the reason we're talking about this is because of the assessor in reassessing any property. And it's something that probably comes up quite often, as a matter of fact. A lot of times we see people making transfers without it being insured. That's another issue, but between spouses, co-tenants, family. So a lot of things like that occur. And of course, there are certain obligations that you must meet. So a transfer of an interest doesn't only occur based upon its sale. It can be done through a gift or inheritance, right? Transfers that constitute a change in ownership can occur by any means, including transfers that are voluntary or involuntary, occurs by operation of law, transfers by grant, gift, device, for example, a gift that you receive from a decedent whose property is in probate. An inheritance, for example, trust or contract of sale, or adding or deleting a proper name from the grant deed also is considered to be a transfer of an interest. So we're here to talk about, are those certain transfers subject to reassessment by the assessor's office? And in certain cases, yeah, they are. And then remember, anytime there's a change in regards to a transfer of an interest, it's subject to reassessment. And if the Prop 13 base year value is greater than, or excuse me, if the market value is greater than the Prop 13 base year value, your taxes are going to go up. If the assessed value is lower than the Prop 13 base year value, so everybody get a property tax bill. You bought it for $1 million. Let's just assume you're lucky enough the tax rate's only $1 million. So in that year of purchase, you're going to be paying taxes of $10,000, property taxes. And then Prop 13 is going to limit the increase. So every year, assuming values go up, the assessor can increase the assessed value by 2%. So in my example, the next year they can increase the assessed value up to $1,020,000. That now becomes the Prop 13 base year value. So that's what we're competing against. And then also, if the transfer is only proportional, if it's a 50% transfer, only that interest, that 50% interest, is subject to reassessment. And then there's a number of transfers, and some, all the transfers are subject to a reassessment. Some are excluded by law, so they can occur automatically, or you have to apply for the exclusion. So that's what we're going to talk about today, are a number of the exclusions, assuming there is an exclusion available, and how to take advantage of that. So changes, there's two different types of reassessment or exclusions. One that occurs automatically, one in which you have to apply for. Let's talk about those exclusions that you actually have to submit a claim for. Transfers, now the first 3 bullet points, I'm going to clarify this. Hopefully everybody can see that because I don't see that there. Okay, thank you, thank you. All of these bullet points are applicable to transfers occurring February 15th of 2021 and before that. So there's still opportunities for individuals to take advantages of these transfers and file for an exclusion. And that's why I wanted to bring this up. These have all been replaced by Prop 19, effective February 16th, 2021. However, let's just talk about these because people will ask you the oddest questions. And so that's why I want to talk to you about that. You used to be able to transfer a principal residence between parents and their children, and the base year tax value would transfer to the children. So that's no longer available, at least not under circumstances. Then also, families could transfer up to $1 million of investment property without reassessment. So that is no longer available after February 15th, 2021. But if there was a transfer that took place at that time or before that, the exclusion is still available to those individuals who received that property. So that's why I want to mention this. And then also there are exclusions associated with transfers between grandparents and grandchildren, but there are certain conditions that had to be met. For example, the parents had to be deceased, first of all, right? So that's one of the exclusions. And then so that means parents had to be deceased before the date of transfer. Application has to be filed. And once again, this is effective for transfers that occurred February 15th, 2021 and before.
So, Rich, you're saying that if the grandparent leaves the house to the grandkids after they pass away, that the parents have to be gone too for this to?
Well, under the former law, under Proposition 58, they could transfer it without any reassessment, assuming the parents predeceased the date of the transfer. So yes, parents have to be dead. Transfers between parents and children were permitted. So now this is another exclusion that's available. But now Prop 19 has replaced that, and we'll talk about that. Then other exclusions that you actually have to apply for: transfers of a family home between parents and their children. And under certain circumstances, only is that available, and that's under Prop 19, as a matter of fact. So you must file an exemption claim for that. And then this is very important because we see this more often. I think the marriage rate in California has dropped dramatically, I think nationwide, as a matter of fact. So when we're talking about co-tenants or domestic registered partners, it's more prevalent now than ever. So I think it's something that we all have to be familiar with, and that's part of our discussion today also. But in this case, transfers of a principal residence between two co-tenants that occur upon the death of one of the co-tenants. So let's go through the details and I'll explain each and every line item. Let's assume, so to obtain the exclusion, the two co-tenants together own 100% of the property as tenants in common or joint tenants. So the vest of the property as tenants in common or as joint tenancy, which has right of survivorship. And then those two individual co-tenants must have owned 100% of the real property at the time of death of one of the two co-tenants. And then if there's more than one co-tenant, 3 owners on title, then the exclusion is not available to them. And then the other qualifications, the two co-tenants, people that own the property, must have owned and occupied the property for 1 year before the date of death. And then there's certain I've got it up here on the screen. And then also the surviving co-tenant must now own 100% of the property. So what are co-tenants? It could be two friends that bought a property together, for example, we see, or people that are investing together. So they'll take a property, they'll vest it as Richard and Carlos. We each own a 50% interest, and it could be vested as tenants in common. It's an interest in the property of 50% interest, or joint tenancy, it's an undivided 50% interest. So we don't see people, investors together, usually taken as joint tenants, but it's possible. So we bought this property, we would have a partnership agreement. So this does give us or the surviving individual the benefit of not having that property reassessed if one of us dies. So that's a big benefit, as a matter of fact. And that's also available to registered domestic partners. And we're going to talk about that also. Yes.
Do you want to share the screen?
Oh, I'm not sharing the screen. Oh, shit. I didn't have to say that, did I?
I'm saying it's on the screen.
Yeah, I thought it was, right? Thank you, Carlos. Got it finally. So now the first bullet point we're looking at on the screen refers to Prop 19. So the next exclusion that's available is the purchase of a replacement dwelling by a person who's 55 years of age or older or severely disabled, where the replacement dwelling will be that person's principal place of residence and is purchased or newly constructed within 2 years of the sale of their original property. So this is referring to Prop 19, and this is something that's invaluable to you, especially if one of the individuals you're speaking with is 55 years of age or older. So if a married couple, registered domestic partners, it's available to them. However, and only one person must be 55 years of age or older to obtain the exclusion. Now, my example before, I said we purchased a property for $1 million, owned it for 2 years and I'm being reassessed every year. So let's just assume the assessed value is $1,040,000 approximately. And I sold that property for $2 million. If I'm 55 years of age or older, I can transfer that $1,040,000 assessed value to the replacement property for which I paid $2 million for. Now, 100% of that would transfer if the value of my property today was $2 million. So I held it. Real estate value is high. I've gone up. So my property I'm selling is worth $2 million. I'm buying a property for $2 million. I can transfer my $1,040,000 assessed value to the replacement property. So instead of paying 1% of $2 million for property taxes, which is $20,000 a year, I'm paying $10,040, 1% of the assessed value that was transferred, which is $1,040,000. So you can see the dramatic benefit, and you can do that 3 times within a lifetime.
And so does the property have to equal the value of the property you sold, or
It does not necessarily. So if I buy the replacement property before I sell the property I'm occupying currently, it can't exceed 100% of the value. I'm not saying sales price, because value and sales price are 2 different things in the assessor's eyes. So you may even buy a home for $1 million and you've reported that today because I closed escrow, but the assessor may say it's worth $1 million too, and they can assess the property at that. And they review each and every transaction to see whether or not the selling price equals the value of the property. So in that example, if I bought the replacement property before I sold my current residence, then I can't spend, or the full cash value of the replacement property can't exceed the full cash value of my existing property. However, if it does, the difference between the two will be added to the assessed price, if there is a difference, right? So if I buy a property and it's worth more than the property I've relinquished, if there's a difference between those two, the selling price of my property and the full cash value of the replacement property, that's going to be added to the assessed value.
So if you buy it for $500,000 over what you sold it for, then you're getting taxed on $500,000 additionally?
Yeah, but let's assume I bought that house for $500,000. My assessed value is $500,000, and I'm buying a property for $1 million, or actually $1.5 million. Usually you'd pay 1% on $1.5 million, correct? Whatever the purchase price is. But in this case, I'm going to transfer my assessed value, $500,000, and I'm going to pay tax on the difference between the full cash value of the property I sold versus that of the property I acquired. So 500 plus 1.5 million minus 1 million is another 500,000. I pay tax on $1 million. So I'm saving taxation on $500,000 in value. Any questions about that? Okay, very great. So that's invaluable when you're speaking to clients, as a matter of fact. Everybody wants to know what they can do to avoid an increase in their property taxes. That same guideline applies to a property that was taken by government action. So maybe along the freeway, your house was taken because they needed it to widen the freeway. Well, the same exemption is available to transfer your assessed value to the replacement property. And then this is interesting. Yeah, it's the least they can do when they're taking your property and forcing you to move. I think they're probably doing you a favor if you're not living next to the freeway. And then another interesting aspect that's available to somebody, if previously exemptions were not available to registered domestic partners, and there's 2 types, one that's registered via the state, one that's registered locally. So between the period of 2001 or 2000 and 2006, if there's a transfer involving registered domestic partners registered by the state, they were reassessed. So now they're not reassessed if there's a transfer between a registered domestic partner. So they can go back and recover that money that they were improperly taxed because the law made it retroactive. So there's another exemption, as a matter of fact. And the same thing is true for locally registered domestic partners. I'm not exactly sure the difference, except one's at a state level, one's at a local level. So they can recover those monies that they spent or shouldn't have paid tax on.
Is registered domestic partner like another, like kind of saying that you're not married, but you're with the person?
I'll explain it in a manner which I understand it. So there's marriage, And then there are those individuals that say, I love you. I kind of want to be with you, but and I want you to get the legal benefits associated with being married. Maybe my health insurance plan is going to cover my spouse, but now it's extended to registered domestic partners. The law itself, in regards to giving exemptions from reassessment for property tax, is another benefit, as a matter of
I
fact.
didn't know there's the registration process.
Yeah, there is a registration
Damn it, I
process.
got
for it.
married.
Yeah. So, you made the ultimate commitment, Carlos.
Domestic partner, in that case, when they want to split, do they have to go through the divorce?
I would say it's not a divorce process, but there's probably going to be some type of property settlement agreement. As a matter of fact, it's not going to carry the same weight as being married. So I wouldn't.
Does the attorney?
I would say so, especially if there's a dispute over money. It's you don't need an attorney to get a divorce. It's just that there's a dispute and anger. That's when people typically obtain legal counsel. So I would think it's probably something that's going to occur. It's probably occurring more and more, as a matter of fact. I think that's part of the reason less and less people are getting married now. There's all these other implications associated with it, right? I don't like you and I don't want to come home anymore. And then let's see other exemptions that are available. So we talked. I do know. Have I said anything? I used to be much more offensive, I can assure you, right? But I've changed also.
I think Mary is.
Yeah, she probably is. I love you, Marianne. There we go. I want that recorded, right? So now, once again, exemptions. If I actually have a domestic partner and I added that domestic partner to title, if I pass away, that transfer can occur without a reassessment of the property. And then let's say, and then others, let's say the third bullet point down, transactions only to correct the names of the persons holding title to real property. I'm married now. I added my spouse, and that spouse decided to change their last name. So I can change that, and that is not subject to reassessment. And then let's see, and then transfers, this is important, of real property, because this is occurring all the time now. Transfers of real property between co-owners that result in a change in the method of holding title to the property without changing the proportional interest of the co-owners, such as a partition of a tenancy in common. Tenants in common and joint tenants can also petition a court to partition a property. So if we talk about a partition, there's a difference. I can own two separate parcels and they're independent of each other, but I own one parcel and Carlos and I are partners and we've decided that we don't want to work together anymore. Carlos wants to sell his interest. I don't want to sell my interest, so we can go to the court. They can partition a property, allowing him to sell his interest, and then I'm not subject to reassessment.
How does that work? Only half of it's reassessed, so there's a.
In this case, no reassessment would occur.
Oh.
But if you and I are partners and we bought two properties and it's Rich and Carlos on title to each one, and we decide that we want to each grant the other person our 50% interest, so I only own one and you own one wholly, that is subject to reassessment.
But if I were to sell my interest to somebody else,
Your 50% interest would be subject to reassessment.
how does that work? You're each taxed separately?
No, they're going to, if the assessed value is $1 million,
Yeah.
they're going to look at $500,000 and reassess that to whatever 50% of the total value of the property would be. So then the future tax could be based upon $1,250,000.
So it affects
The remaining former co-tenant, as a matter of fact, or partner, exactly.
Oh, by the way, we have a question or comment here.
Oh, love you too. Okay. Thank you, Marianne. That's very nice. That's funny. And then let's see. And this is, I'm sorry, I said the other part's happening all the time. This is what's happening all the time. Transfers between an individual or individuals in a legal entity or between legal entities, such as a co-tenancy to a partnership. Now I'm going to address each one. He and I individually bought a property. We decided to transfer to a partnership in which he and I each own 50%. It is not subject to reassessment. or a partnership to a corporation. Now, Carlos and I each own 50% of the partnership. We transfer our interest to an S Corp, in which we both own 50% of that S Corp. There's no reassessment. But if there's another shareholder in that S Corp, it is subject to reassessment. And then transfers that result solely in a change in the method of holding title to the real property. And remember, it's the proportional interest of the transfers and the transferees that matters in this case. So as long as a proportional interest that Carlos and I each own, we can continue to transfer it to a different entity. If the proportional interest in that entity to which we transfer that property is no different, there's no reassessment. It's not considered a transfer of an interest. Then, of course, if a lender terminates the loan on the property because it's been paid off, that is not subject to a reassessment. Substitution of a trustee of a trust or mortgage. If you have a revocable trust, you see there are trustees in that trust. So if you substitute a trustee, it's not subject to reassessment. And then also, if you look at a deed of trust, that's a security instrument you give a lender when getting a loan or a mortgage. There's a trustee name on there. So if they substitute the trustee's name out, there's no reassessment. Also, you probably knew that already though.
They sell the loan out to someone else? Is that what you're saying?
Yeah, or it's going to be paid off and they're going to reconvey their interest in the property. So transfers that result in the creation of a joint tenancy in which the transfer remains as one of the joint tenants. So I bought a property. I'm now married to Mary Ann. I transfer title from Richard Moore to Richard and Mary Ann Moore as joint tenants. That is not subject to reassessment. Transfers of real property to a revocable trust. Mary Ann and I now have a family revocable trust. We bought a home, we put it into the trust. It is not subject to reassessment. And that's assuming I retain the right to revoke that trust and transfer property out also. So there are conditions of which that's applicable. And then also, this is an interesting one, transfers of real property into a trust that may be revoked by the grantor. So that's me. I created the trust and I transferred property into the trust. I'm a joint tenant on the property in which for the property I transferred into the trust. For Carlos in this case is the other person on title, and he's also a joint tenant. So if I transfer my undivided interest into my revocable trust, it's not subject to reassessment, even if I name Carlos as a beneficiary to my trust, even though he's not a family member.
So it would not.
You would not be subject to reassessment, correct. And then transfers of real property to an irrevocable trust for the benefit of the grantor or the creator's spouse. All right, so that's a simple one. I put it into my trust for the benefit of my spouse. And then also, there are some tax planning advantages. Charitable remainder trust, for example. If I transfer my interest into a charitable remainder trust, meaning I no longer have access to the principal amount I transferred in, but actually I can have the benefits going to myself or to somebody else. That is not considered to be a transfer. Now, charitable remainder trust, that's tax avoidance. That's really what it is, to transfer these assets into this entity without having any kind of taxation. Okay, and plus you can write off the gift, which is obviously very, very helpful. Then I've got a couple of questions just to go over. And I do not intend to share my screen now. And then one thing I wanted to emphasize, Carlos and I bought a house. He transfers his interest. His portion that he is subject to transferring, or that he transferred, is subject to reassessment. Right? And then we see a lot of transfers occurring all the time. So we see sometimes people trading title on homes and it may not be recorded. Do you need to file a change of ownership form? You do, as a matter of fact. Typically now when we record a transfer, a grant deed, when properties sell, there's a preliminary change of ownership report that's attached, and that satisfies the requirement. And that's how the assessor knows about everything that's taking place, right? They see the recordation. As a matter of fact, for Orange County, you probably want to record anything if it's a sale of a property without a preliminary change of ownership report. And how about this? My mom, sister, and I purchased a commercial property as joint tenants. If mom grants her interest to me and my sister, does this constitute a transfer? Yes, it does. So it's subject to reassessment, also based upon her 1/3 interest. And please don't confuse federal taxation and state taxation with assessed values. We're not talking about traditional taxation. And then if I add a friend or sibling on as a joint tenant to my property, would this cause a reappraisal? Or what if I add them as tenants in common? So if I add somebody as a joint tenant on a property, it is not subject to reappraisal. If I relinquish my interest, it is subject to reappraisal. If the person I added relinquishes their interest to me, it is not subject to reappraisal. However, adding somebody to title as a tenant in common is a change in ownership unless an exclusion applies. So adding somebody as a tenant in common, I added Carlos as a tenant in common, in essence, selling him 50% of the property. It's that 50% is subject to reappraisal. And then my domestic partner and I live in a home that I own. May I transfer 1/2 of my ownership interest in the property to my partner so that we could hold title as tenants in common without the transfer being a change? Yeah, so the difference is now, I said in the last example, Carlos now becomes a tenant in common with me. So that's subject to reassessment. But if I'm a registered domestic partner, and I add Carlos on because he's my partner, it is not subject to reassessment. So that's one of the benefits of being a registered domestic partner, as a matter of fact. And then leases, it can actually, if the term of a lease is greater than 35 years, we see property in Newport Beach subject to land leases. So if there's a transfer associated with a property that has a land lease with more than 35 years left in the lease, it's subject to reassessment also. And then how do I inform the county assessor that I purchased a property? Well, I'll go over those basics. If the transfer is recorded, you have to notify them at the time of recording, and a preliminary change of ownership form is typically attached, and that's form PCOR. And then next, if the transfer is not recorded or a change in ownership report not filed at the time of recording, sold my property to Carlos, he doesn't record it, the assessor doesn't know, we still have an obligation to report that transaction within 90 days of that occurring. If the change of ownership was a result of a death and there's no probate, meaning, for example, I have a trust, I'm now the decedent, right? It's not subject to probate, then you must file a change of ownership statement within 150 days following the date of my death. And if it's a probate, then it's subject to filing a notice of change at the time the inventory and appraisal report is filed. Now, one of the most common things that's happening in terms of reassessments that we see, people don't really understand it, but I've sold my property and during escrow, I'm the seller, my assessed value is $1 million. Carlos bought it for $2 million. 7 months down the road, Carlos is going to get a supplemental tax bill because the time, at least for a portion of the time he owned it, it's still showing an assessed value of $1 million. So keep in mind, months down the road, when you're speaking to your clients, they call you and they question, why am I getting not just my regular tax bill, but I'm getting 1 or 2 other supplemental tax bills. We can look at the dates on the supplemental tax bill, and it should have an effective date from the date I recorded sale of the property through the end of the tax year, for example. And then the other one that happens so often ever since Prop 19 came into effect, and that, remember, that was February 15th, 2021. When somebody dies, it's considered a transfer. And now the assessor is going back and 9 to 12 months following the date of death, because that's going to be recorded, an affidavit of death is going to be recorded. They're now sending a supplemental property tax bill to the decedent's estate. And it's coming out about 9 or 12 months following the date of death. So that usually is a big surprise to somebody, because if someone's 90 years old and they've lived in that home for 50 years, their assessed value is $200,000. And now it's worth $1 million. So now from the date of death through the current period, I'm going to get a supplemental tax bill based upon that additional $800,000. And people are very surprised when they're seeing that. And the statement is, why didn't you tell me? So that's very helpful when you're speaking to somebody, as a matter of fact, who has had a death in the family, and if you think there's a transfer of the property. And then one other thing that does happen, I wanted to mention, sometimes there are escape assessment bills. And that means the assessor, for some reason, didn't realize that the property sold and it's transferred hands again and again. Well, they can send out an unsecured tax bill to you, an escape assessment for that period of time. Or maybe you made improvements to the property and they've looked at all the building permits and realized that you made improvements dating back 2 years. And the value of the improvements is $1 million. So they're going to send you an escape assessment bill also for something like that. So the assessor does the various things. They read the newspaper, they look at building permits, they scan neighborhoods, they're looking for any type of improvement in which they can increase the value or assess value of your property.
So if it's been transferred over a few times and not recorded until the last owner, that person is responsible for all the taxes and no one in between.
Well, everybody has an obligation within so many days following the transfer, in 90 days, to notify the assessor of the transfer. So the assessor can actually, for an escape assessment, can go back at least 8 subsequent reporting periods to recover that money. And then the penalties and everything else are going to add up. I can probably assure you, if you're engaged in a transaction and there's a title company involved, then it's going to be done properly, because the assessor's not going to record that grant deed without a preliminary change in ownership report. But we see a lot of issues a lot of times when attorneys are amending the trust or creating a trust for somebody who transfers their property, their home into the trust. Well, a lot of times it's just the attorney may send it in for recordation. Also, it's not an insured transfer, so that can be another issue, as a matter of fact. So there are transfers that occur on title quite often, which are uninsured, meaning a title company is not involved. So that actually can cause issues in the transaction for you, as a matter of fact. You may have to go back and have the prior transferors, the person who transferred their interest, sign an affidavit of uninsured transfer, for example, to verify that they did indeed intend to transfer their interest in that property. And that's the conclusion of my presentation today. Do we have any other questions that came up?
In that scenario, what if the person died that you're going after to sign the affidavit of uninsured title?
And I think it's a problem.
What happens?
Well, I think that's, yeah, Carlos is right. So if you have these transfers that occurred and you have to go back to somebody who sold the property, signed a grant deed transferring their interest. Now, if they're deceased, well, there's probably going to be some other methods. Did they have a trust, for example, somebody that oversaw the trust itself? But then the title company is going to have to make a decision whether or not it's an insurable transaction if they can't get validation that that person intended to sell their interest in their property. If it goes back 30, 40, 50 years, I think a title company is going to insure it. It's probably going to say there's not much risk. There's always risk, but it's less likely. All right, well, there's one question. Anybody else? So Prop 19, remember that. That's very important for anybody that's buying and selling a home. I forgot, in regards to Prop 19. So we talked about the example of buying a home and being able to transfer my assessed value to the replacement property. If the replacement property was acquired by me before the sale of my existing primary residence, the full cash value cannot exceed 100% of the full cash value of the relinquished property. Now, I don't buy a replacement property till year 1 following the sale of my primary residence. So if that's the case, then the full cash value of the replacement property can go as high as 105% of the full cash value of the relinquished property. So if I have a home, I sold it for $1 million and I found my replacement property within the year following the sale, I can buy a home for up to $1,050,000 while it having any increased assessed value. Then if it's year 2, it can be up to 110% of the full cash value of the relinquished property. So my example, in year 2, I can spend up to $1.1 million without having any additional taxation or assessed value on that replacement property. So you must purchase the replacement property within 2 years before or 2 years after the sale of the relinquished property. Okay. Any other questions? Nope.
Like everybody another.
I think they're just bored to death. That's what I think. That could be likely. Well, hey, thanks for coming, everybody. It's good to see you. Woo!
Thank you.
Bye.